Paul, so I guess we're calling Walmart kind of the unofficial end of earnings season. It's basically all the companies have already reported for the second quarter at this point. What's the relevance, significance of this mark of a best stock performance season during reporting season in this span, except to say that, obviously expectations and fears maybe got too low?
Right. So I think, Mike, you hit the nail on the head. Coming into earnings season, if you remember, I think we talked about it on Closing Bell at one point in early July, talking about how analyst sentiment had become extremely negative heading into this reporting period. The pace of negative revisions outnumbering the positive revisions by levels you don't see too often. And what happened? The bar was set very low, and we rallied about 10% this earnings season. The best earnings season going back to 2008 was second quarter reporting period 2009. And when you look at other periods where you've even rallied 5% during earnings season, the question becomes, have we borrowed from the future? When you look back, that has historically hasn't necessarily been the case. Returns from the end of earnings season, so from around when Walmart reports to the end of the quarter, have actually been slightly better than average versus all other earnings seasons for the rest of the quarter, and the same consistency as positive returns. So instead of borrowing from the future, I think we're getting payback from, say, the loan we gave in June coming into earnings season, when the market just plummeted on concerns that this was going to be an earnings disaster, and when we sort of reached peak Fed panic over inflation with the that now infamous Michigan confidence report and the CPI report for the month of May that was reported in June. So I think it's a good sign that the companies came in and did much better than anybody was expecting. And so from a fundamental perspective, that's positive, because in June we were expecting earnings estimates to come way lower. And what we've seen is that it hasn't been nearly as bad as people thought.
If you go back, okay, so this was 2009 is the last time you had this similar dynamic. We were coming out of a massive collapse in overall earnings and, an awful deep recession, prolonged bear market that was really much more severe. And so therefore, it's understandable that, the fundamentals analysts would have been a little bit slow to catch up to where earnings were headed. I wonder if it's similar now. I mean, what are we seeing in terms of the revisions to the next couple of quarters to suggest that the good performance we saw around earnings season now is not essentially, just a little bit of relief ahead of ultimately what we're going to have to face, which is a tougher spot for earnings?
Well, so again, not trying to make the comparison and say this is going to be a repeat of coming out of the financial crisis and market performance from that perspective. But just looking from I'm just saying that's the best we've had since then. What you've seen is everyone was expecting weakness and these estimates were going to come down, but analysts haven't had to rein in things as much as people thought they would. So that's a positive on a fundamental basis. And then just looking at the overall market performance, we've seen a very sharp reversal in breadth. We had practically no stocks in the S&P 500 above their 50-day moving average in June. Today, it's up to 90%. So when you look at periods where you've seen an cumulative AD line for the S&P 500 is at a new high, S&P still is about 10% below its high. So that's a divergence, but that's a positive divergence, what we call. And when you have 90% of stocks above their 50-day moving average, when you first get to that level, forward returns over the next 3 and 12 months there's been about 20 periods since 1990 where it's happened. Forward returns have been positive over 90% of the time. And what's unique about this period, and again, it comes back to 2009, and I hate to make that comparison because, I don't think it's going to be that type of performance and nearly that strong, but you have 90% of stocks above their 50-day moving average. You have less than half of stocks above their 200-day moving average. So going back to 1990, you've seen that happen in April 2009, October 2011, and May 2020. All of those returns following all of those periods were quick. And what the comparison is, you had a very sharp drop and you had a very quick recovery. You had sort of that V recovery. And in those prior times, the market did, very well. And so we think the market can do maybe not necessarily very well, but, somewhat well and, better than a lot of the alternatives and better than what a lot of people are expecting. Every time the market goes up, we see another note come out from a firm saying don't trust the rally or the easy money's been made. But still to today, every day we see buying on strength lately over the last 2 weeks.
Yeah, no doubt about it. Feels like some similar rhythms. The 2011 example is quite interesting because, boy, sentiment got real despondent at that low as well as it did recently. We'll see how it plays out from here, Paul. Appreciate it. Thanks a lot.